Everyone says do your own research, but loan agreements are written by lawyers, so how can you understand them? Ted and I have some thoughts starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
At some point in life, virtually everyone gets a loan. Ted, have you ever gotten a loan in your life?
What day is it?
Bingo! Yes, we've all had loans at some point in our life. So, and on this show and in real life, of course, we're always saying to people, do your own research.
Do your own research. I don't know what that means, but
yeah, it's easy to say, but it's hard to do in real life. So,
right.
So Ted, let's talk about diet. What percentage of your calories should come from protein, fat, and carbs?
Huh?
Okay. For optimal health, how much vitamin D should you consume each day from food and supplements, and how much should you try to absorb from the sun?
Vitamin D?
Exactly. No idea. Now, what they say is you're supposed to do your own research. I don't know.
I want to research vitamin D or diets. What are we talking about here today?
Let's not talk about any of that. You're a money guy. Those are stupid questions. How about this question? If my mortgage is up for renewal,
right,
which is a question everyone is asking, has now, should I go for variable or should I lock in for 2 years or 3 years or 5 years, or what should I do?
Well, so it depends.
It depends.
There's a great answer.
There's your
right?
answer. It depends.
Depends on what you think interest rates are going to do, what you think your income is going to do. Are you likely to sell and move in the near future? You want to stay where you are forever? I mean, there's so much going on that it's unique for every individual.
Right. So for us to sit here and say, well, you should do your own research.
Yeah.
Okay, well, I have to figure out what the future is going to look like then.
It is a 30-minute radio show.
Exactly. So that's why we have to do this. So the point is we don't know the future, and different experts are going to have different opinions. I'm sure I could find someone who would say you should go variable on your mortgage and someone who should go long-term fixed.
Yep.
And they may both be right depending on your situation. And, as for the whole diet thing, I don't know. Like everybody's completely different, right? So today we are not going to give specific answers. You should do exactly this,
right? Because
everyone's situation is different. But what we're going to try to do is walk through the thought process so you can figure it out for yourself.
Sure.
Not really doing your own research, but you can come up with.
We tell somebody to do the research. We're going to tell you the kind of questions to ask.
Exactly.
Right.
So because we're money guys, let's talk about loans. So first topic: debt consolidation loans.
Sure. Those are mythical beasts, like unicorns that we used to be able to get for people.
So, okay, what is a debt consolidation loan? I take my existing debts and
you pool them together. You get a single loan or a line of credit to pay them all off.
Okay, so I've got, let's say, 3 or 4 different credit cards.
Yep.
And I want to get a debt consolidation loan to pay them all off.
Okay.
So what's my thought process? Should I just keep paying my credit cards, or should I get a debt consolidation loan?
Yeah, well, so let's look at the different aspects of this thing. So you've got 3 credit cards. What's the interest rate on each of those credit cards? What's the interest rate going to be on the consolidation loan? What are your minimum monthly payments on those 3 credit cards? What's the payment going to be on the consolidation loan? And what's the total amount of debt that you have? Are you even going to get approved for the consolidation loan?
So we can kind of make a chart and figure out what the correct answer is.
And that's all research you can do yourself that you actually understand.
And in fact, what I will do for everybody watching today is I will put in the show notes on YouTube a link to a calculator that you can use to crunch the numbers. So it appears that the answer is obvious. Mathematically, I've got credit cards where the interest rate is 20%. If I qualify for a debt consolidation loan at 10%, is this not a no-brainer? Is it not obvious that I should just take the loan and run with it?
Well, I mean, it sounds obvious, but it's not. So the first is, are you even going to get approved? And I think that's a much bigger challenge than anybody really here wants to admit, because the banks will all tell you they'll give you a consolidation loan, but almost none of them will actually lend you money to pay off another bank's debt. So you have those 3 credit cards we used in the example, RBC, TD, and Scotia. I bet no one of those 3 banks is going to want to give you a line of credit or loan to pay off the other 2 banks' debts.
Well, and if I have those 3 credit cards and I'm not able to pay them off in full, then that probably indicates I don't have the security, the assets, the cash flow, whatever.
Yep.
Something has happened in the past. So I agree with you. It is perhaps less likely that they will agree to the consolidation loan.
Well, and fundamentally, a loan is different than a credit card. So credit card, every month, they tell you what your minimum payment is. And then, frankly, you can go out and spend it again the next day. With a consolidation loan, there's a fixed monthly payment, and you are paying down the debt over time. So it's not actually as flexible from a cash flow perspective as those credit cards are.
And if your credit is a little bit impaired, they're probably going to want security.
Yes. Now, a security or a cosigner, I mean, something that basically says to you, we will approve you for the loan, but we need a little more confidence. Somebody's got to help you. Either we want to put a lien against your house, or we want your brother Eddie, who's got all kinds of equity in his house, to give us a loan on that one.
Good
or
old
something.
Eddie.
Right.
Where's Eddie today? Yeah, the reason there's a difference between 20% interest on a credit card and 10% on a loan is the risk profile for the bank is different.
Right. Now, if you do have if it becomes a second mortgage, probably you'll do a little better than the 10%, although not necessarily, right? It depends on how many other debts are in line in front of them, which is what you were just saying.
Yep.
The risk assessment.
So it seems obvious, but in real life, it may or may not be. And
right.
You and I have seen this 1,000 times in our careers where a consolidation loan seems like a good idea, but when we actually do the numbers, we go, wait a minute, you went to that second-tier lender who isn't a chartered bank.
Yeah, so the 10% interest is a dream. It's going to be higher.
40, yeah. We see lots of 45% interests.
Yep.
And we go, why did you do that? Well, because I had 3 credit cards and I was paying on this date and this date. So now I've only got 1 monthly payment. It's easier for me.
Sure.
Okay, but you were paying 20%. Now you're paying 45%.
Yep.
And instead of being able to pay it off over 4 years, it's now going to take 8.
Well, and I'd be willing to bet you dollars to donuts. That's a Homer Simpson
dollars
joke, right?
to donuts.
That you didn't cancel the credit cards. And so you're using them to top up your cash so you can make the payments on this new higher interest loan.
Yeah, exactly right. And the second tier lender may not care if you've still got those other credit cards or not.
They're indifferent.
They may actually not mind because at least that gives you a bit of capacity. If you get behind on their loan, you can take a cash advance and pay it off.
Or 2 years from now, you'll come back and say, I need to re-up this loan to cover off these debts again.
Yeah, if a bank is going to give you a consolidation loan, it is not uncommon for them to say the term is, one of the conditions is you got to cancel those other credit cards.
Right.
But if you don't cancel them, you're right, then you end up getting into more trouble.
You double down. And we see that happen more often than anything else. So.
Yeah, and it's not necessarily a deliberate and evil thing. I need the cash. I pay off my credit cards, but then the car breaks and I need...
Well, and in fact, you're penalized. If you cancel those credit cards, your credit rating is going to take a hit. So you're trying to do the right thing here, get a consolidation loan, a lower interest rate to help you clear up your debts, and they penalize you for canceling other debts that you're no longer using.
Yeah, because your credit score is based on history. The longer you've had the card, the more support it gives to your credit score. So, okay, we just mentioned the word cars, so let's talk about that. You are the car guy
Cars,
here.
let's talk about cars.
Cars. So, same question as before.
You get your snow tires on yet?
I do. My winter tires. We call them winter tires now. We don't call them snow tires. Winter tires. And as soon as I put them on, it snowed. So I caused that.
There you go. It's your fault.
Everyone's mad at me. So we went through the thought process to get a credit card. Should I, or a consolidation loan? What's it going to work? So now let's go through the thought process for a car loan. So I want to, buy a car, maybe, trade in my old one, get a bigger one, whatever. So, okay, I go to the dealership or the used car dealership or my bank or whatever. What's the thought process then on getting a car loan? Is it basically the same as what we talked about earlier?
So the fella selling you the car is probably more interested in selling you the loan because they make lots of profit off the financing of cars. And so they're going to convince you the only thing you got to look at is the payment. And they'll break it down however they have to make you realize that this is great, I can afford the payment. So monthly? Well, no, let's make it even lower. Bi-weekly when you get paid, because then you'll have the money. And it's not just the car payment you got to look at. It's all the other aspects of owning a car. So there's the gas, there's the maintenance, there's the cost of parking. How much are you going to use it going back and forth? Are you still going to have to get supplementary access, what do they call them? A transit card in Toronto or something, right?
Yep.
It's more than just the payment. In fact, the car payment is probably the least expensive thing about owning a car.
And my winter tires. Let's not forget about those, right?
Forget about your winter tires.
Yeah. So when you do the math, so you mentioned the
Petro Pass or a transit pass.
Yeah. So every transit authority has something different, a Metro Pass or whatever. So right now, the TTC, let's use that one as an example.
Yep.
The base adult Metro Pass is $156 a month.
Okay.
And there's different categories if you're paying for it for a full year and if you're a youth or an adult or a kid or whatever. But let's take that as the base number. So I'm trying to decide, is it worth it to get a car, or just continue to rely on transit. So obviously there are some non-monetary factors here.
Right.
With a car, I can get in my car and I can drive there. With transit, well, I got to wait for when the bus is running or whatever. So there's more to it than just the money. But walk me through the money then. So because you already listed a whole bunch of different costs.
So let's start with the basic one. So we're not dealing with the payment at this point. Let's start with the gas. Right, so you're not taking the bus anymore, but you got to put gas in the car, or you got to be able to plug it in if you're one of those people with an electric car. You got to maintain the car, and that doesn't mean that I only have the money when something breaks. There's ongoing oil changes. There's winter tires. You got to know that 3 times a year I've got to take it in for some kind of service. So the smart thing to do is to set the money aside in the budget for those things. And depending on the car, they can be pretty expensive.
Yeah, because sometimes when you go in, they say that your ball joint and rocker arm is busted.
Right. Sometimes.
Could happen. Like it did last
when
week.
You're putting your winter tires on?
When you're putting your winter tires on. And I did wonder why the car was always going in this direction while I was driving it, because, of course, I drive a car that has 250,000 kilometers on it.
Right.
So you're right. You kind of have to – you don't know when the repair is going to happen.
But it's going to happen.
It's going to happen. So you kind of have to build into your budget, okay, I don't know, if it's an older car, $100 every month, and because every repair ends up being many hundreds of dollars.
Right. Well, and insurance. And, again, depending on where you live, or more importantly, your gender and your age, insurance can be ridiculous. I mean, I know lots of young folks that are paying more money for their insurance than the car's worth.
Well, if you're a 20-year-old male,
you might as well take the bus pass.
You can't afford it. Okay, so you've talked about gas, maintenance, insurance, and so I don't know. Gas depends how far you're driving, but that could be a couple $100 a month.
Well, I mean, it's $1.75 to $1.90 a liter now, depending on if you're regular or premium.
I think it was only $1.55 when I drove here this morning.
Well, that's because you live in Brantford.
Okay, there you go. It's in the boonies, but even at that, it depends how far you're going, obviously. But can you fill up any kind of vehicle for $50?
I have a vintage Austin Mini that I can still fill for $30, but I can only go 200 kilometers.
Well, and you got that Honda.
my Honda Beat.
Which no one has ever seen, but it's about the size of this table here.
That's right.
Other than that, you're probably putting in $100 or something.
Right.
And if that only lasts you a week, well, then you're talking many hundreds of dollars. Maintenance, we already talked about that. Right. Could be $100 a month if you averaged it out over the life of the car. And then you got the car loan payment. So again, I'm going to put a link to the calculator in the show notes. But if we assume you're buying a $50,000 car, and I don't know if that's a lot or a little because I haven't bought a car.
It's a medium level car.
Medium level car. Okay, so let's say I got a $10,000 down payment.
Okay.
So
you're lucky.
I'm lucky. Now, how much am I paying? Well, I'm paying $50,000 plus here in Ontario. You got to pay sales tax, right? They add 13% to it.
Funny that way.
$56,500, so $6,500 in sales tax. So my loan, if I have $10,000 down, is going to be $46,500.
Right.
If I get a 60-month term, and if the interest rate is 6%, how much am I paying every month?
$900 a month.
And so over the life of the loan, that's around $7,500 in interest.
Yeah, it's $54,000 in payments, right? 900 times 60.
There you go. So it's actually $7,439 in interest, but we're just rounding off here.
Right.
Okay, so a buddy of yours is considering buying a car and getting a loan. What's the thought process? I guess the starting point is considering all the costs.
Yeah, make sure you actually budget all the costs. Because remember, the salesman's going to tell you, well, it's $900 a month, $450 biweekly, $225 a week. And all of those, it's smaller and smaller, and this sounds great, and you're all excited because it's shiny and new. And then you realize I don't have the other $1,000 a month it's going to cost me to keep the damn thing on the road.
Have you ever seen a car loan that's more than 5 years?
Sure. I hate them. I mean, you may recall, I used to rant about these guys. Aren't they up to 7-year loans now?
Well, I think you can do 8 years.
Oh, you're just doing that to get my engine going.
Yeah. So the difference between a 5-year and an 8-year loan.
It's 3 years.
He did that in his head, folks. That is unbelievable. The monthly payment is only $611 a month on an 8-year loan.
That's good. $288 less.
Right. But you're paying for 8 years, so now you're paying $12,000 in interest as opposed to the $7,500 in the previous version.
Wow.
So it's actually a lot more. So you're not a big fan of 8-year loans, I guess.
I'm not a huge fan of 5-year loans.
Because something can happen in 5 years or 8 years.
I can almost guarantee that something will happen. I mean, cars are better made than they used to be. But any kind of repair now outside of warranty is significantly more expensive than they used to be, too. I've got a pretty simple tool kit that I work on, that old Mini and the Beat, because these are cars that are dead simple. You can't do that with my daily driver. I can't, you open the hood and I don't know what the hell this stuff is. If you don't have a computer to plug in, you can't talk to the car anyway. So.
Can't do it with my car, and it's an old car. So, right. And are you going to have a stable job for the next 8 years? I don't know. Like, take a look at what's happened over the last 2 or 3 years. Things have really, really bounced around. So, okay. So again, with a car loan, you got to look at a whole bunch of different factors. Final type of loan we're going to talk about is installment loans. And you remember good old episode 429 a few weeks ago where we talked about credit card installment loans.
Yeah, right.
You weren't a big fan of those either, as I recall, but at least the interest isn't horrific on those.
Yet.
So we're not going to spend a whole lot of time on that. But again, I'm thinking about getting an installment loan, so I'm not necessarily consolidating other debts. I'm not buying a car.
Right.
What is the thought process I should go to when I'm deciding whether or not to get that kind of loan?
So anytime you borrow, what's the purpose of the loan? So is it actually worth it to you to be borrowing this money and paying somebody interest for whatever it is you're using the loan to cover? Can you actually afford the payment? So again, think this through. They're going to make it sound like the payment's quite manageable, but you got to factor in all of your other costs. And of course, who are you borrowing from? So are you borrowing from a Schedule A bank? Are you borrowing from lots of money for free on the internet? That's 49%.
You don't have any Italian heritage in you, do you?
Just a little. Sicilian.
Theodorus Michalos. Sicilian, there you go. That's part of Italy, isn't it? Yeah. So, okay, what is the ideal time frame on a loan then? Is shorter always better? Is longer always better? Like, how do you think that through?
Right. So first and foremost, whatever you're borrowing for, the item that you're borrowing for should survive longer than the loan payments are going to take. So, I mean, right off the bat, if you're borrowing money to take a vacation, I would probably look at you with stern concern. That's just a bad idea.
Your vacation is 5 days and the loan period is probably longer than 5 days.
Correct. So the car loan, okay, is the car going to last you for 5 years? All right, well, then a 4-year loan's okay. Is it going to last you for 10 years? I have my doubts, but it's possible.
Hey, I'm driving a 12-year-old car. Yeah. I mean,
that's why it's okay to get a mortgage for 25 years on your house, because I'm pretty sure it's going to be there. But if you're getting a loan for something that's already gone, that's a pretty serious concern.
But there is, the longer the loan,
usually
the lower the monthly payment.
Depending on the interest rate. All right. So if you have a choice between identical interest rates, a 5-year loan and a 7-year loan, the 7-year loan will have a lower monthly payment, but the interest cost in total will be higher.
Depends if we have an inverted yield curve. We should do a whole show on the inverted yield curve.
Why don't we do that?
But yes, in general, the bank is making a risk assessment.
Right.
And so the longer the loan is going to last for, the more likely they're going to want higher interest to compensate them for their risk. So in the example of the car loan we gave earlier, okay, if it's a 5-year loan, you're paying, $800 a month, but in a 8-year loan, you're only paying $600. Right. That's great. So from a cash flow point of view, the longer the loan, the better, but I'm paying so much more.
Right.
So it comes back to kind of bite you in the end. So, okay, now we already talked about the chances that the bank is going to give you the loan.
Right.
What happens if they decline you? So you go in to get the loan and they say, oh, sorry, no, can't do it.
So you need to ask them why you were declined. And there got to be some kind of good reason. Usually it's because your debt ratios are out of line, which means you already owe too much money. They think it's too risky for you to pay back this particular loan. But it could also be the type of people you've already borrowed from. So, for instance, if you're trying to get a consolidation loan or a line of credit from a bank and you're dealing with a bunch of payday lenders and installment loan lenders on the internet, they're not likely to want to deal with you because you've already turned to these higher risk lenders. You've got a bunch of debt. And even though it's financially smart to switch it to a single loan, they're not going to want to do it because of the risks associated with the way you borrowed in the past.
Yeah, banks only want to lend to you if you don't really need the money.
Yeah, if they're sure they're going to get their money back.
Now, you talked about these ratios and everything. So what is a debt service ratio? What are you talking about there?
So it's basically what's it cost you to make your debt payments every month compared to your income.
So if I make $1,000 a month and my debt service cost is $300 a month, I got a 30% debt service ratio.
Right.
And so every lender has some kind of computer that says, oh, this is how high you can go.
Yep.
And if it's a mortgage, okay, maybe they're willing to let you go higher.
Well, the mortgage, they factor in other things too. So it's not just your payment, it's also your taxes, your insurance, and the utility costs. So it gets a little more complicated. But
so in an ideal world, what you would do before applying for a loan is you would pay off all those other debts so you don't look so bad, But of course, you can't do that because
you get
that's
the
why
loan.
you're trying to get the loan.
Right.
So you're kind of pooched. It may make sense to get rid of one or two of the smaller payday loan, high interest rate loans. But
well, so as ridiculous as this sounds, let's say you're dealing with a major bank and you still have room on your credit card, you're better off to pay off those other loans and consolidate your debts yourself with the bank and then go ask them for a loan or line of credit. Because a bank will be happier, not happy, but happier to consolidate their own debts than somebody else's. Remember what I said earlier. They're not going to lend you money to pay off one of their competitors' debts because now they're assuming all the risk that the other guys had before.
Yeah, unless your situation is really solid. It's like,
Right.
hey, we really want this guy as a customer.
If you don't need the money,
Right.
they'll happily lend you the money.
I've been working at this job making $200,000 a year for the last 5 years, and I have all these assets, and I'd like to put an RSP at your bank. Okay, fine. Then they're willing to do it. But that's just not the case for the average person. So, okay, let's wrap this up. This will actually be a shorter show than what we normally rant on about. So like this is good. We've kind of narrowed it down.
We haven't done the commercial yet.
That's right. Let's do that's a good point.
All right.
That's a good point. We also haven't mentioned all our sponsors. You remember that episode with all our sponsors? Because nobody responded and we've got
seen $0.
responses. Okay, so you're right. We forgot about the commercial. So let's do the commercial here. Our shameless self-promotion. So you go to the bank and they say, you know what, you don't qualify because your debt service ratio is out of whack. You've got all this debt. We can't do it.
We don't think you can make the payments.
So, okay, now what?
Well, believe it or not, the bank's probably doing you a favor. Because if you've got more debt than you can handle and they won't help you, instead of going to a higher risk, higher interest rate lender, you ought to talk to somebody like you or I. I mean, the obvious option is to consider a consumer proposal.
So I've got $40,000 worth of credit card debt and some income taxes and a payday loan and a bunch of other stuff, which I cannot possibly service.
You can't service it, and nobody will approve you for a consolidation or a line of credit. So what are you going to do?
Because the servicing costs on that, depending on the mix of your debts, but if it's high interest stuff like payday loans and credit cards, it's easily $1,000 a month.
That's probably more.
And could be $2,000 a month.
That's right.
So they come in to see you and you do the math and you go, well, okay, if you make, I don't know, $3,000 a month or whatever, and we're going to do a consumer proposal on this $40,000 worth of debt, what is that likely to cost you?
Yeah, probably you're going to pay back $12,000.
So that would be $200 a month over 5 years.
That's right.
And right now I'm paying somewhere between $1,000 and $2,000 a month.
And you can't make the payments.
And I can't do it. And when I go to the bank and ask for a loan, they say no.
Right.
So does it matter what my credit score is if the answer is no?
Well, and that's another one of those fallacies. When's the last time we did a credit report show?
Oh, we'll have to add that up.
Add that to our list. But yeah, if you think you got a great credit score and you got great looking credit and nobody will approve you for credit, then you don't.
Right.
Right? It's pretty simple. It's only as good as the last time you were able to use it.
Yeah, having a score of 700 but getting declined. Might as well have a score of 900 then. Like
right.
if it's and it's not just the score, obviously, because like you said, the bank is looking at a bunch of other things too, right. Debt service ratios and so on, which don't necessarily show up in your credit score. So okay, so the bank declines you for a loan. That may be the impetus to start thinking about other options. Now, of course, if you own a house, maybe you sell the house. Maybe you can finance that. If you've got an extra car that you don't drive, maybe you can liquidate that.
So the irony of all this, of course, is, folks, so the bank has turned you down. You're going to call us. The first thing we're going to ask you if you talk to the bank. So we always look at what are the options that you can consider, and then we narrow it down to, well, this is the option that makes the most sense for you.
Right, because if you can consolidate and therefore – and the payment is reasonable, well, why not do that?
Right.
There's nothing wrong with that. And if you think, hey, my situation is going to get better, I'm going to get a raise next year, I'm going to get some more overtime, I can actually pay the loan off quicker, great.
That's
fantastic.
Right.
So we're happy to do that. But if you can't, then, I guess the consumer proposal becomes the option to consider. So, okay, final advice then. What is your final advice when you're talking to someone and they're considering getting a loan? Obviously, you go through the thought process, maybe a consumer proposal is a better option. But let's assume that the loan is a viable option. What's the thought process?
So do not simply focus on the payment, because the payment is only the tip of the iceberg. You need to look at your entire budget, the costs that you're going to have to incur, not just the payment, but all of the other things associated with it, whatever those things might be. And the other is, of course, what's the total cost of borrowing going to be? So they approve you for a loan. It's at 10% interest. You're doing it over 5 years. But the cost of that loan is still going to be, The example we had earlier was $7,500 on $40,000, right? $46,000.
Yep.
What could you do with that money if you didn't take out the loan? Where would you spend that money someplace else as opposed to giving it to someone else for renting their cash?
Yeah, and in some cases, you have no choice.
Right.
I think, every house you've ever bought in your life, you had a mortgage.
Yep.
And not every, but it's very common when you buy a car.
Most people for cars have got some kind of financing.
I don't have $30,000. I mean, even if it's a used car for $10,000 or $20,000, how many people have $20,000 just sitting around?
Right.
So it's very common to get a loan for those purposes. And it actually makes financial sense in a lot of cases.
Yep.
Because by buying that car, I can now get to work, which means I can make more money.
Yeah. If you compared it to the cost of doing Uber twice a day to get back and forth to work, or even bus passes, at some point, the convenience of the car makes sense. You just got to be careful.
Right. And there's nothing wrong with public transit. And when I'm in downtown Toronto, or when I go to Toronto, I'm taking the train, I'm taking the subway. I'm not trying to drive all around there.
Right.
But if you work at a job where you start at 5 a.m. and the buses start at 6 a.m.,
you got a problem.
Kind of need a car. So we're not opposed to doing anything like that. We're just saying do the math up front. So
think about it.
Don't focus on the monthly payment. And you gave the classic example. Here's the weekly payment that the car place gives you, because that makes the number seem as small as possible.
Very manageable.
Very manageable. And I guess if you get paid every week, I'm in favor of making the payments every week.
Right.
But do the math, multiply by the term of the loan, and make sure you understand. I mean, going back to that car loan, so I have to pay $56,500, but really I got to add $7,500 to that.
Right. So that's really what the car costs.
Right. This is a well over $60,000 investment I'm making. Is that really what I want to do?
Most cars aren't investments.
Yeah, virtually none of them are if you're going to drive them. So would I be better off buying something cheaper, taking transit longer, whatever? That's the thought process. So I agree
Mooch
with
off
all
my
that.
parents. Oh, wait a minute. That's
whatever
a different show.
Whatever you can do. So, and I agree with all that. My final comment would be, don't be afraid to ask questions.
Right.
So you don't have to sign the documents right while you're sitting there. You can say, look, I need to pause here.
And think about it.
So,
nobody's as interested in your life as you are.
Right. So I'm going to go away. I'm going to read it. I'm going to talk to someone who maybe understands this more, but I'm also going to do the math. So if I take the monthly payment and multiply by 60, how much do I end up paying? What other fees have you put in there?
Right.
And when you look at it that way, that may help you make a more informed decision. You may still get the loan, but at least you know what you're getting yourself into. And also, what happens if I miss a payment? Then what happens? So is there, there's this fee and this other fee and the other thing and the
Depends
other thing.
on the lender. But anyway,
so
that's a show all in itself.
Yeah,
actually.
so you want to understand fully what you're getting into. So there you go. We haven't told you what to do. We have given you the thought process to analyze it.
We have told you how to do it.
But we've told you how to do it. And I will put in the show notes links to all the different, there'll be a few different calculators for mortgages and car loans and installment loans and so on. So you can actually go in and type in the numbers and see what it all totals up, and then make the decision for yourself. So there you go. That is our show for today. As always, please subscribe, not link, like. There you go. Man, I got to get better cue cards for this. Subscribe. We've now got well over 8,000 subscribers on YouTube, way more than that on the audio version. So Spotify, Apple Tunes, we are everywhere. So we appreciate you listening. Thank you very much. That is our show for today. Until next week, thanks for listening. I'm Doug Hoyes for Ted Michalos. That was Debt Free in 30. 2840. Beautiful. I'll go grab my call.